Okay, 10:03. I guess we'll give it a start, give it a go now. Good morning and good afternoon to all. I hope that's covered all. Anyway, it should be. Wouldn't think that anybody will join us during night. I guess my name is Chai, and I'm the chair of the More Australia Asia Desk. On behalf of the Asia Desk, I would like to welcome and thank you all for joining this webinar. The webinar is about sharing with you all some general information about mergers and acquisitions in Australia and New Zealand and some of the support services we provide. This is, next slide please. This is a joint initiative of the National Asia Desk and National Corporate Finance Committees of the Australasia. It is in line with the role of the Asia Desk being a marketeer for the network, promoting cross-border engagements between Australia and Asia Pacific. Today, we will have two speakers, Miss Vanessa Wu from Australia, Director of Business Advisory, have 19 years of professional experience, including M&A, of course, across many industries, having worked in both China and Australia. And we also have Mr. Murray Tuck from New Zealand, Senior Manager, Tax and International Advisory, equally have extensive experience and exposure to M&A across many industries. I hope you all could gain some good insights from them. Without further ado, let's have our first speaker.
Thank you, Chai. Thank you for the introduction. Ladies and gentlemen, thank you all for attending to our seminar today. Firstly, I'd like to give you an overview of the M&A activities in Australia and New Zealand in the last 12 months, including some of our success stories. Then we'll discuss the More approach to M&A and our service offering. We'll also address the cross-border transactions in the APAC region before we finalize today's presentation. When we look back in the last 12 months, it certainly has been a very challenging year. With the threat of the new COVID-19 variant, the instability of Russian and Ukraine war, fears of inflation, and the earlier than expected interest rate rise. Despite of all these challenges, Australia and New Zealand mid-market has seen an exceptional year with significant increases in both deal size and numbers in the M&A area. There were about 870 deals published in the year compared to 690 deals last year. The average deal size also increased. It was 45 million, an increase of 8 million compared to last year. The top performing sectors including IT, services, and financial services. Worth noting is also the consumer retail industry. The number of deals have increased by 80%. This includes retail, food, and others. More Australia has been a key player in this market. I'd like to showcase just a few of our success stories. In December last year, we provided financial and tax due diligence service to Credit Clear, a financial technology company listed on the Australian Stock Exchange, for their 46 million acquisition of ARMA. Credit Clear has been a client of ours for many years. In the December and January period, we also provided transaction advisory service to RPL Trading, a chemical material company, for their successful acquisition by IMCD. In the April to June quarter, More Australia Corporate Finance team has also provided transaction advisory service to Anchor Mark and TC Boxes for their successful sale to the investors. Those businesses are in the construction and manufacturing sectors, respectively. I'll now pass the microphone to my colleague Murray, who will give us an overview of the M&A landscape in New Zealand and the good work they do over there.
Thank you, Vanessa. That's just following on from the busy time that more markets more in Australia have had. Things have been very active here in New Zealand for the last 18 months as well. We've seen in the year to the end of 2021, roughly 200 transactions and another 100 in the first 6 months of this year, and that compares to the 2020 year, or the 2020 year, where there were only 50 odd transactions because obviously COVID, and we had quite extensive lockdowns in New Zealand over that period. Looking forward, we're sort of seeing a somewhat quieter pipeline here in New Zealand, but that is probably just a function of the uncertainty that we're seeing going forward. Of the activity that we've seen to date, most of the buyers have been trade buyers. So roughly 80% of the activity we've seen tends to be people within the industry looking for something to expand their business and grow in an area that they already have knowledge and expertise on. And that is something that makes a great deal of sense. The other 20% is private investors and private equity, but there is a bit of a caveat around that I'll talk to in a little bit soon as well. From the point of view of geographical spread of purchases, we again see quite a few out of New Zealand. Roughly half the transactions are New Zealand businesses acquiring other New Zealand businesses. Of the remainder, we see another 25% of the purchases mainly being sourced out of Australia, and the rest from a very wide geographic spread around around Europe and around China and Asia generally, in North America. The caveat that I put on those trade purchases and the source of the purchases generally is that a good example being a recent deal that we have been involved in, which was a purchase of a value-add industry in New Zealand, adding value into primary produce processing here, was a purchase by a New Zealand company within a trade and within an industry that they're already heavily involved in. But they themselves had been purchased probably about 3 years prior by a private equity firm out of China. So while it probably hits the statistics as being a New Zealand company and a trade purchase, private equity and private investment is still driving the market to a fair extent from the point of view of funds and from the point of view of setting prices as well. The sectors we see interest in is information technology, like Australia, like Vanessa was talking about. Not quite so much in the finance area, although there is some activity around that. But given most of our 4 major banks are publicly owned Australian companies anyway, there isn't quite the same sort of high-level M&A activity in that market. The second most important, or the second most common industry we see deals in is chemicals manufacturing, which is a bit of a strange name for something that involves a lot of processing of primary produce as well. So we see quite a bit of that. Going forward, demand is kind of moderating a little bit. We look at our pipeline and we hear anecdotally that there isn't an awful lot in the pipeline, but there are still very well organised purchases, and there are still very good businesses that are for sale. And our own personal pipeline here in Markham's is looking like we'll be busy for a little while yet. So we hear generally that things might be slowing down, but our own experience suggests that there is still quite a bit of activity in that area. And I'll just pass you back to Vanessa now to walk through the service offering and how we can help.
Thank you, Murray. Now I will talk about our approach to M&A and our service offering. For us, M&A is about building owners' value through corporate transactions. There are 3 main decisions we help our clients make. Should we invest? How we will fund it? Should we exit? And there are 2 ways we can provide our services. One being the lead advisor, and all provide transaction support. The differences between the two are self-explanatory. We can be as involved as the client requires. In the lead advisor's role, we will take the lead and guide our clients through the whole process. In the transaction support services, we'll take a supportive role and provide information that's needed for the decision making. I'll then go through some of our lead advisory services, which typically start from origination. This includes everything from idea generation to first contact with potential targets, understand the client's investment objective, formulation and adaptation of their strategies. To illustrate, I'll give you an example, which is the CS Digital. It is a software company based in New South Wales in Australia. It services both government and private contracts. Originally, they are seeking capital for growth. Through our process and discussion with the client, we identified and introduced a few suitable acquisition targets to help them to secure funding to acquire these targets as an inorganic growth. We help them with the government funding scheme. In the quite a lot of local government, they have the SME loans. So this worked out to be a great way for the objective they had for growth. Throughout the transaction, we help client to analyze all aspects of the transaction and identify opportunities and mitigate risks. We manage the whole entire process, ensure the deals is conducted professionally and efficiently. We will also help the client to create marketing materials, including IM, management presentation, term sheet, and other collateral to promote the client. Given the many different types of M&A transactions, we have presented the various types as petals clustered into this flower. Worth noting, IPO is one of the effective capital funding and exit pathways. We have assisted many clients with their IPO process, from idea generation to preparation for listing and finally going public. We have also included the step-by-step typical core M&A service in this slide, which can be used as a reference involved in any M&A transaction. After identifying targets and funding options, one of the important steps is to determine the optimal acquisition structure. Should you buy the business or should you buy the entity? As an example, every deal is different. We help clients to determine the most suitable structure, set up appropriate investment vehicle, and advise on the contract terms, including building in an earn-out or performance-based terms in the contracts. Among other things, we also assist clients manage their regulatory requirements. This may include Foreign Investment Review Board approvals. Sometimes clients only require us to provide transaction support services. And one of the important services is financial due diligence. Today, I picked out three. The first one I want to talk about is financial due diligence. This usually is for the buyer side. We help clients understand the risks of the acquisition, which assists them in forming their offer and obtaining bank finance. We typically look at integrity of information provided by the vendors. Does the financials represent a fair view? What's the sustainability of the earnings? Is the historical data reliable? And is there potential growth in those earnings? From the point of transaction on, would there be potential synergies or would there be costs? Continuing investment and cash flow requirement needed from the investors, we will need to consider that. Also, we recommend the client to include the tax and other compliance risks due diligence in this process. Later, I will talk about that in a bit more detail in terms of tax due diligence. The second most important service we provide in transaction support is financial modeling. The financial model is a three-way forecast of the business operations. It almost serves as a crystal ball, if you can have one, to look into the future. It includes scenario analysis by changing underlying assumptions and drivers. We found this largely improved the decision-making process for the business owners, because it creates better visibility over the future profitability and liquidity. It is also often required when the buyer trying to obtain bank finance. After buying the business, this model can also serve as a basis for specific performance measures and monitoring. Earlier, we talked about building earnout and financial performance factors into the contract. So you can use the financial model to monitor the performance and adjust as per the contract terms. With this financial modeling, we can also help the business to improve their operation by tracking how they perform and adjust the different assumptions and scenarios, advising them on how to build enterprise value. The third important transaction support service we provide is valuations. We can provide formal independent valuation reports by our accredited valuers, which are suitable for reliance, or if the client requires, we can provide informal calculation methodologies to assist client to put a value forward for their negotiation or bargaining. We have listed a few of our success stories on the right-hand side of this slide, including value services provided to a well-known property group, Option. This Option business is a property group. They have part of their business being property valuations used by the local government. We are providing valuation to the valuers in this sense. I'll now pass the microphone to my colleague Mari, who will talk to us about MAA service in New Zealand and some of the services they provide.
Thank you, Vanessa. We are next slide, if you could, please. We see quite often those three areas, financial and valuation, and the cash flow looking forward, the budgeting and the crystal ball exercises being quite important, and they really work in tandem together when you're helping a client through a transaction. One of the hot topics, although it's a perennial hot topic, so I'm not sure there's so much a hot topic as something that we often get asked, is around valuations and what sort of multiples we see. And it's kind of hard to put a range on this because we do see valuations fall outside this range, but this is the range of 3 to 7 seems to be where a lot of them wind up lying. Certainly in New Zealand, we struggle to see vendors of good businesses selling for less than 3. We had one case a few years ago with a client who was quite keen to sell, and the multiple was about 3.5, and the purchaser was very much questioning his forward order book. And the couple that were selling went through it, and they realised that they actually had a pretty good forward order book. And if they kept the business for 2 or 3 years, then they would easily earn what they were going to receive for it. So they did. And a few years later, catching up with them, they were very happy with that decision. They still have an excellent business, which is very saleable. And in the meantime, they've been running it very profitably and doing very well. So the number 3 seems to be a bit of a floor under what we see as values for anything that isn't too distressed. We have seen a couple of businesses recently that have had good exposure to profits during the pandemic struggle to match that on most recent historic earnings. But that is a function of, again, looking forward and the amount of risk there is in their earnings. A 7 times multiple is certainly available for good businesses with fairly certain earnings, or also where there is scalability. Certainly in IT, we see that, and we see multiples from time to time go well past 7, where there is a good product or a good app in New Zealand that an overseas buyer with a good distribution channel is very keen to get hold of, because they know that they can sell it outside into a much larger market than perhaps the New Zealand vendor has been able to reach, even in today's remote world. So those sort of multiples can get quite high. There are always different dynamics that drive different outcomes. We see in some circumstances and in some industries at certain times when there is a consolidator in the market looking to build scale, that again, the multiples can go quite high past that. But again, it comes a lot back to the quality of the earnings and the certainty going forward, and the old tried and true investment approach, that risk and reward go hand in hand. So for good, certain returns, and for good opportunities, even when there is a bit of work to be done, we certainly see higher multiples. The other hot topic that we just wanted to cover off on, sorry, Vanessa, next slide, please, was the sale and purchase agreement. And one of the things that we find in a lot of these transactions that we're involved in is one, and sometimes both parties don't have a lot of exposure to this process, and they will get together and make a very good deal that is astute from a business point of view, that works well for both parties. And then they both engage solicitors and accountants, other professionals, and we all find that the deal is agreed is perhaps a little bit different to what our templates or our expectations around working capital requirements and that necessarily expect. And an understanding of the client's mindset is pretty vital in those circumstances, and a review of the sale and purchase agreement to make sure that it matches what everyone thinks the deal is, particularly what our client is expecting that they are receiving in terms of a business, what they are expecting, or that if we're doing vendor support, that the proceeds that they're expecting are going to be realised as well. So that is one of the other services that we offer here in New Zealand. We've helped quite a few vendors work through those sort of issues. Some of the things we like to see in a SPA, hopefully early on, it's covered off, is a good definition of debt, and also particularly a good definition of working capital. We have had 2 transactions recently that have very much gone down to the wire and almost tripped over the wire in some respects when it comes to discussions about what constitutes working capital and inadequate working capital. A lot of the templates that we see and a lot of the expectations are around it continuing on with a same level of historic working capital. But one of the sale and purchase agreements that we dealt with mentioned simply adequate working capital. And this was very much a service-oriented business. They didn't have a lot of payables, but they certainly had an awful lot of receivables. And the collection of their receivables would fund their business for about 2 or 3 months. Partly because they weren't realising it. So we had quite a discussion and eventually got an adjustment to the sale price that recognised that in a bit more money for our clients. And while these probably shouldn't be deal killers when you get close to the end, we do find that a bit of emotion and a bit of pressure enters into it. So we'd encourage to sort of look at a SPA earlier rather than later. Do a dry run through the completion accounts, see how the SPA actually responds to the balance sheet, and actually do a rehearsal of settlement to see, how the balance sheet's going to respond to the SPA, and make sure that it works out well for all parties and it's what people are actually expecting. The other thing as well that we like to see covered off in a SPA is some sort of mechanism for a delay in settlement. Obviously, we try and avoid these. We work very hard with our clients and their advisors, and also with the other party, to ensure that everything is running smoothly. But things happen, basically, and they need to be recognised, and some sort of an opportunity that recognises that just because it can't be done this week doesn't mean it cannot be done further down the line, and some sort of compensation or appreciation of how the profits accumulate for an extra month or an extra couple of months, and the vendor is recompensed and the purchaser isn't disadvantaged, we find is quite important in the SPA. That is also an awkward discussion to have when you realise that you're getting close to completion and that we're not in the position to sign the SPA. How that actually works when you've got a lockbox that's set at a certain date, and possibly in the past, as we've seen recently, and whether there is a ticker for a daily average profit, or whether profits that are earned in the delay accumulate through to working capital. These are all things that it's good to understand earlier rather than later. The other rather interesting ones is Overseas Investment Office approval, and also Commerce Commission issues when they haven't been considered earlier on in the piece, become quite surprisingly urgent later on. Again, we had a transaction that was agreed and all documentation was ready for signing, and one of the directors further up the hierarchy in the vendor and the purchaser said, well, hang on, have we covered off Commerce Commission? Because these are two very related businesses in an industry which isn't exactly crowded with competitors. And they wanted that covered off despite the fact that it had been discussed. We had to go back and revisit that. So it's one of those things, again, just to make sure that there is some sort of documentation or exchange of correspondence early on to ensure that that everyone is on the same page with that. And now I'll pass the mic back to Vanessa.
Thank you, Murray. Thank you for the interesting stories and war stories in New Zealand. Earlier, I talked about financial due diligence, and as part of the financial due diligence, I want to address the tax due diligence. Typically, our corporate finance team will work with our tax experts in a financial due diligence engagement, and using the expertise of our tax advisors in this particular piece. Typically, this happens from the buyer side. When the buyers want to acquire a entity instead of the business, it'll inherit all the tax or hidden issues this entity comes with. So we will need to look at the accuracy of lodgements, including their past tax returns, whether they have traded certain transactions correctly, whether there will be any underpayment of tax, the validity of any deductions they claimed in the past. We also need to have a look at their compliance and lodgement history, see whether there's any audit risks that the upcoming owner would have to deal with in the future. Also worth noting is other than income tax or GST or VAT, there's also employment tax issues that we need to particularly look at. There can be quite a lot of indirect tax issues, including payroll tax, work cover issues, and superannuation or pension risks for the owner who's taking over the business. So we will normally engage the tax team members to help the client going through the business and have a very detailed review of cover off on all the risks. From a seller side, We also help the client to consider any tax-related issues. Especially, we help clients to, from an early stage, prepare the business for sale in the ways of how to maximize the business value, how to pass the tax due diligence that might be coming from the buyer side. Also understand what the transaction is in terms of looking at opportunities for a strategy to reduce the tax liability associated with this realization of their asset. So we help the client to prepare for the transaction. This might even start from earlier on, and based on our knowledge and relationship with the client, and prepare them for their eventual sale. Next, I would like to talk a little bit about APAC region, but I believe Mari would also give us some interesting story from the taxation side for New Zealand. Mari, please.
Thank you, Vanessa. Yes, we'd certainly agree with the point of your last slide that preparation is key, particularly when it comes to the whole transaction, but in particular around taxation. We've again been involved in another transaction recently where the vendor had a particularly chaotic structure, and while their corporate tax affairs were pretty straightforward, some of the ownership structure was quite awkward, and having to talk through and understand constant changes from the point of view of the purchase of the selling entities was a challenge, and it kept the vendor pretty much constantly on the back foot, which was quite unfortunate from the point of view of the transaction in general. But certainly our tax due diligence process here in New Zealand is quite similar. There are a few differences in New Zealand, which I'll run through, and a couple of changes that we've had in New Zealand recently, which are favourable in one case, and in another case is just something to be aware of when buying a business in New Zealand. First off, I just sort of like to cover off that we don't have a capital gains tax in New Zealand, and we don't have a stamp duty. So those are one of the joys of working in New Zealand, and simplifies our role a little bit there. Although they haven't been said, I bear in mind the old proverb that no one's life, liberty or property is safe while Parliament is sitting. So it's always possible that these things can change. We've had a change to the loss carry forward rules in New Zealand. Previously, tax losses were only available if a certain amount of shareholding was being maintained from a continuity point of view. But now we have the ability to carry forward losses provided the underlying business is going to carry on, and that provides some good opportunities around dealing with businesses that might perhaps have a fundamentally good business, but for whatever reason are over leveraged or facing some other sort of pressure, to be able to sell that business and still have the tax losses move with them and that tax asset to go as well. The other change that we've had reasonably recently in New Zealand applies less to share sales and more to asset purchases. And that is that Inland Revenue got just a little bit tired of purchases and sellings having different allocations of the purchase price around depreciable assets, inventory and things like that. So they have now, or are now, requiring that be agreed, preferably as part of the SPA, and we'd certainly encourage that. Although if we're acting for the seller, it becomes less urgent, because if it's not agreed as part of the sale and purchase agreement, then the seller has got 3 months to notify the purchaser what they believe the market value split is of the assets that they have bought, and effectively impose that on the purchasers. So it's something, certainly when we're doing a due diligence, certainly when we're acting for a purchaser, that we encourage definitely to make sure is in the sale and purchase agreement, and is agreed up front before it's before any deal is signed. The other matter that sometimes surprises some of our Australian colleagues in particular is in the case of a share purchase scenario. There isn't an uplift for assets that are within the company to reflect that purchase price from a tax depreciation point of view. So the cost price less the depreciation claim to date carries on within the company, and there is no change to the tax depreciation base from that point of view. We also provide advice around structure. Again, from a preparation point of view, as Vanessa was saying, in her tax due diligence, but also from the point of view of the structure of purchases going forward. We've got a rather interesting IT purchase at the moment. We have not been hugely involved in the transaction, but we have done the tax due diligence for it and explaining how things work in New Zealand compared to where the purchaser is based in the UK. And part of the acquisition price is going to be shares in the UK company, and how that cross-border structure works from a thin cap point of view as well, and how it's financed is quite important. Certainly the lead advisor in the UK was happy to hear that we could provide a bit of a reasonably solid benchmark around what they should be looking at from a point of view of leverage in New Zealand and what they should be looking at from a point of view of leverage in the UK. And given a draft forecast balance sheet, we can firm up those sort of estimates quite a lot. So those are the sort of services that we can offer in there as well. From a structure point of view, that's another comment, question that we get from some of our overseas colleagues. We often, eventually, or not even eventually, we often wind up settling on a New Zealand incorporated subsidiary of the overseas company. That seems to work well in most circumstances. For most countries that we have a DTA with, if we can attach full tax credits to a dividend, we'll call them imputation credits rather than franking credits, then there is no further withholding tax liability on dividends in New Zealand, and that seems to work pretty well by and large. Where a bit more transparency and a pass-through mechanism is required, then we have limited liability companies and occasionally branches as well of overseas companies in New Zealand. What we often don't see, and in honesty, we do not tend to use trusts very often, even just for plain vanilla businesses in New Zealand. Trading trusts are comparatively rare in New Zealand compared to Australia. So, and they have the ability to retain earnings unless they're passed out to beneficiaries. So they don't quite have the same sort of transparency from a tax income point of view. So they tend not to be used very often in our structures in New Zealand. If transparency is required, it's often that limited liability partnership or a branch structure where that's required. And now I'll pass back to Vanessa, who is going to talk through APAC and cross-border transactions.
Thank you, Murray. I think it's quite important that we talked about these important considerations often before the transaction as well as after the transaction, and it's quite essential to consider the cross-border consideration in terms of how to get the investors' value back to the investors effectively. Thank you. For the M&A activities in the APAC region, we have observed in the last year, there has been a trend of inexperience and inorganic growth. By inexperience is, what we mean by that is people investing in new industries. And inorganic growth means the growth is by acquisition, not growing organically from their own business, but by acquiring a new business to achieve the objective of growth. A lot of the deals are small to medium-sized, and there are half of the deals are minority interest transactions, being not taking over the control of the business, but just a minority interest in the entity or business. We're facing a economic challenge in the APAC and globally. This challenging time also presents with many opportunities. During a global, I guess, economic slowdown, there has been some opportunities we can identify being lower valuations and less competition. This can be a good opportunity for experienced investors and advisors to have some leverage in this market. With this note, we have summarized the 4 elements of success for the APAC M&A transactions, being defined a clear strategy and making the M&A capability a competitive advantage. Focus on your strategy during the deal execution phase and think about integration. Our team at Asia Desk have in the past and will in the future serve as a conduit and work with our M&A experts to deliver our services to our clients. Today, we have talked about what we do, mainly from the M&A services, and we hope to talk to you more about our other services. Thank you all.
Right, so I guess this is the time where we sort of, before we obviously bid you farewell, so obviously we welcome if any questions from, you know, from this group. Yep. You're supposed to have a Q&A there, but anyway. So you'll notice that we obviously still call ourselves More Australia Asia Desk, and we have 2. But this More Australia do include our neighbor, New Zealand, as well. So unfortunately, we couldn't sort of rename ourselves More Australasia at the moment. We'll see how that's go anyway. So we'll keep you updated on that bit. So just on a little cheeky note, you know, you see that Malcolm's you know, link is probably bigger the font than the More Australia. That doesn't mean that they are more, you know, more prominent than us or whatever. It's probably some you know, cheeky thing there that to sort of show them, you know, yeah, New Zealand is still good.
Well, if we
all right, we have a question here. Does More Australia or New Zealand Asia Desk specialize in any industry in particular? I'll probably get the 2 speakers to sort of, you know, give their opinions separately. Vanessa?
We would probably call ourselves a bit of a generalist. We have had quite a lot of experience among many different industries, but personally, I have worked with a lot of clients in the industry like property, information technology, shipping, as well as hospitality.
Maury?
Certainly, yeah, certainly in New Zealand, we're also a general firm. That having been said, we do have lots of directors with really good specialties in a lot of different areas. Certainly in Auckland, we have good exposure to construction and professional firms, as well as property developers. Out in the provinces, there is a great deal of expertise around primary industry and processing of primary industry, forestry. So the short answer is that we probably have an expert in most things, and we can find them.
Yeah,
it does. It just looks like that way. Yes, Vanessa.
Yeah, sorry. I just wanted to add that if the Asia Desk team doesn't have expertise in a certain industry, we certainly have other partners or advisors that have the specialty in the industry. I think that's Mari and I were.
That's a good point. That's a good point. Anyway, just to reiterate, anyway, as I've mentioned in the early at the start of the webinar. So Asia desks obviously have the role of promoting cross-border engagements between Australia, New Zealand, and the rest of Asia Pacific. So we normally are the marketeers, and we do try to include all experts from respective industries into the committee as much as we can. And that's said, not any one of them can be regarded as the master of all trade anyway. So we do have specialized support, at the back office, if you like, anyway, to support whatever. And what is important is that we obviously would like to see ourselves as the go-to point for all of you out there in the Asia Pacific regions to come to us first, if you like, and so that it's a lot easier for us for you to sort of get hold of the real expert. Now that James has asked another question, which country do you see most inbound investment coming from, Vanessa?
Based on my observation and experience, in recent years, there has been more inbound investment from the US, China, maybe a few years ago, also quite a lot of inbound investment from Singapore and Malaysia.
All right.
Certainly from New Zealand, probably half of our overseas investment comes from Australia. Other than that, it is a pretty even spread. We have seen investment out of Asia, and in particular China, but also Japan. We have seen investment out of the US as well, and out of the UK. And also Denmark and Norway from Europe are the ones that have recently crossed my path. But I think, as a general rule in New Zealand, sort of half of the market gets taken up by New Zealand purchases, another quarter from Australia, and the last 25% from spread around basically the developed and developing world as well.
Yeah, I noticed that James is actually from more Japan, and I believe that recent trends is that Japan's have a pretty good, strong performance in terms of mid-market M&A as well. Surely that's sort of sort of indicate that it is Asia Pacific. This is where we have a lot of what you called it added value or actually very good value assets lying around here. So, and that's where we the whole reason of having this webinar in the first place, is to make sure that we to put out there those are interested in investing in Australia and New Zealand, that we can reach out to us, and so that we can work out something. If just knock on the door on the client, it is the time where we see that there's a lot of opportunities out there, and hopefully we can sort of work have some deals that beneficial to all. Well, certainly that you have my I believe that most of you would have known me by now, so it wouldn't be difficult to get hold of my email address if you like. So I'm also in WeChat, I'm also in WhatsApp, so it seems to be a lot of accounts, holding a lot of accounts nowadays in any of in nowadays. And so please keep all channels of communications open, and we'll hope to see you next time.
Thank you very much, Troy.
Thank you, Vanessa. Thank you, Murray. Thank you, everybody, for joining us today. And yes,
thank you, Vanessa.
We'll hope to see you all next time.